On this episode of Flux News Show, we're going to go through the temperature of the market, the state, how the volatility and volume and open interest have been changing, all the way through to who's been making money, who's been losing money, the hedge funds, what they've been up to, and of course, the refinery margin market and how that's changing. We've got very interesting insight on how the market is starting to make a very interesting turn and maybe a new trend into something quite high conviction for the rest of the year that all traders need to be aware of and get stuck into. We think, as always, we're giving plenty of ideas about what's going on in the market, how we think the market will play out, and we have trade idea videos that we do off the back of this, so be sure to check those out, and we'll be releasing the next one tomorrow. So hope you enjoy, and please share this video with people who might enjoy it. Thanks. Okay, starting with the temperature check. Okay, so for the temperature check now, we're doing volume, open interest, and volatility to get a measure of the market state and talking through that. So Martha, take it away.
Yeah, so starting with the volumes, thanks to the officials data, who we'll cross to later, we can see the total exchange traded volumes for oil derivatives, for futures and swaps. So for the week to the 16th of May, there was 17.36 billion barrels across the futures and swaps, which is up 3.6% week on week. But prior to this, because of the bank holiday, we did see about an 11% drop. So we're yet to kind of recoup those losses.
And we've got a bank holiday, I guess, coming up end of this week. But okay, volumes up. Yeah, I mean, we kind of talked about that last week. So I guess more confidence with tariffs coming back, probably more with the macro traders, more invested would make sense. So I guess I got nothing else really to say on that, but I guess you could follow that up with
comparing weeks.
Say again?
It's hard comparing weeks because every week, but looking at year on year, we're 14.6% higher than the same week last year.
Okay, that is interesting because it's like that organic growth that's happening in the market volumes every year. And I guess there's a difference between looking at just futures in isolation and everything. You know, we are just in a state of like steady kind of compounded growth in financial contracts. So that all does make sense. And I guess the only other thing would be like, we had this view that the hedge funds in particular are having a pretty tough time and winding down operations. So if volumes are staying, it probably coincides with like quite a bit more consumer hedging and like activity in that sense with low prices and that kind of stuff. Like I know we've talked about the hedging a lot previously, but more has kind of come out lately as obviously as the time has passed. If we rewind back to when the Brent was around 60, there was a huge airline came in and apparently bought the crap out of calls and was there kind of Cal 27, 28 Brent and buying a huge amount of size. So it kind of just backs up the theory that really was what was going on. So how is that married with the open interest?
So looking at the open interest, first of all, just looking at the ICOT data, we can see that it's pretty much flat week on week, less than 1% movement coming off, less than 1%. But Prodmerc saw a more significant move, about 3% from longs and 1.5% from shorts removed. So sorry, should I say that all again?
Yeah, it's fine.
Sorry. Okay. So open interest across the whole curve saw a small decrease, but I mean, it was next to nothing, less than 1%, about 0.78%. Prodmerc will risk off both long and short, removing 3% of length and 1.5% of short positions.
Okay, and I guess we'll find more as we talk about, you know, the CTAs, how they may have changed, switched positions, and who's kind of done what. But that's pretty immaterial, I would say, overall.
Yeah.
I mean, there's like pockets here and there of people, you know, profit taking, short covering, things like that. But we'll get into that.
Looking at money managers, their net positioning is up in the week. They added 22% week on week to their long positions, which is fairly significant. We're just over the year average, but we are 26% below the 5-year average for money managers net positioning.
Okay. And I guess volatility to round it off.
Yeah, I mean, just for one last thing, I forgot to say, looking at the Brent futures options, looking at the open interest at the respective calls and puts, we can see that the highest open interest is in the high 60s calls, but looking at the open interest for $70 and $80 calls, it's the same. And the open interest for $80 calls is higher than the interest for $50 puts.
Yeah, okay. And well, actually, I'll wait to summarize what I think. But the volatility then in general.
Yeah, I mean, volatility is down. Both implied and realized volatility is down. It's about normal levels. Early May, it was really high, and then we've seen it fall to about 30% implied volatility in the options. The calls remain at a discount to puts, just in the most basic terms. So, and the volatility structure is pretty flat in the front few months. So, in the front few months of the futures curve, I mean.
Yeah, okay. Just because we're introducing volatility more. I mean, implied versus realized volatility. When we say implied, we mean what the options, the actual contracts are trading, right? What they're reflecting. If people are buying a crap load of options, we're basically saying it's implying. People are the expectation is of volatility. People are, I guess, more in a state of uncertainty, that kind of stuff. And then realized is like the actual kind of how are you measuring realized volatility?
Realized volatility is just looking at standard deviation.
Yeah, standard deviation. Okay, yeah. So that kind of makes sense. But either way, kind of down, which is
down but normal.
Yeah, down but normal. But remember, we've not really been in much of a normal year. So we said this last week. This concept like normalisation. So all in all, I think that kind of says to me a temperature of the market that's pretty basically taming and normalising still, and kind of finding this homeostasis. I mean, we did kind of call for a bit of a market sell-off last week, which we kind of did and didn't get, but volatility also decreasing, which on sell-offs is kind of like rare, right? You expect that volatility increase. So it just looks like a relatively balanced thing. And then we'll get into the headlines and stuff. But again, we talked about headline fatigue, people not reacting as much to that. And that seems like the case even now.
Yeah. And what you said about the money managers, I mean, like equities are back up to sort of Trump fuckery levels, and maybe that's just why people are starting to, like, if they're building bullish positions, I don't know, it's like this sort of sentiment from the US stock market is that everyone's kind of like ready to go again.
Yeah, exactly. So I would summarize it like basically if you've lost a lot of money, you've licked your wounds, it's been tough, but it's kind of out of it now, start again. If you've made a lot of money, you've taken your profit, and it's just like go again, like you say. And I guess the good part of that is traders generally run things on a calendar year, so you're almost halfway through the year, made or lost money, you've got another half of the year to kind of go again, and as more volumes and certainty come.
So just looking at the screen here, we can see that April had a really, really high volumes in the early month, and then that dropped very low as players were kind of wait and see for OPEC. But this month, we've seen far more stable volumes, probably averaging about 500 million barrels a day in Brent.
Yeah, okay. Well, overall, that kind of makes sense. How do we summarize that? Basically like lukewarm, kind of normal, basically.
Yeah.
All right, great. All right, now let's move to the herd mentality. Okay, so herd mentality, what's driving the market from a headline perspective or like a theme perspective? I guess what has to be said is Iran, right? That's the main thing.
I mean, the two larger things, the geopolitics, but Iran, we've kind of seen this difference between conversations had in private and conversations had in public, which now, because of social media, we've seen the foreign minister of Iran come out and tweet, which we'll get up on the screen and post, basically saying you can't trust anything the US is saying. It's not what they're saying behind closed doors. And it kind of just brings, we can always speculate on diplomacy, but I think it just brings, it's so modern to be able to just see a tweet about that. I don't know, that blew my mind.
Yeah. Also, the point you made about maybe like a month ago, which I now see so many times again, is when Brent ticks higher, you get all this stuff from the US being like, there's going to be an Iran deal with all this stuff. It's like, Yeah,
it does hold true.
Like it does hold quite true, and it has been for the last month, but it seems like...
Well, I think he's playing through his game plan, right? So it was lower inflation, and we were all a bit like, how is he going to do that with energy prices where they were, and it felt like the balance of things. He made his deal with the Saudis, most likely, the arms deal, things like that, got oil prices lower, energy prices went with it. Which he said would happen. Then obviously the Russia-Ukraine ceasefire, even though nothing's happened, the talk of that really hurt gas prices. So that was it, lower inflation. And then it was obviously his tariff thing. And I think he's just working through the next thing, which is Iran or peace now, right? So Iran, and he wants obviously the Russia-Ukraine stuff as well. But he can't have those things in progress and inflation come back, right? So I guess that it kind of makes sense. So the sensitivity level, 65, 66 on Brent, but I would probably say he's going to be looking at WTI more. The administration is going to be looking more at WTI more. So maybe anytime it's above 60 would make sense that, we want it to be around 60 or lower. So that's probably when you get
because
sensitivity.
he's quite openly said, hasn't he? He's like, what is it, like 50 to 60 or something is like the range, is like a good range for oil. So
yeah, you're right.
I feel like he did say that. Maybe it was even 40 to 50, but it was below here basically. Where he was like, that's a good range for oil to be in.
And he's released, we talked a few weeks back about ethanol waivers, things like that. Like, and this is with summer season pretty much here or around the corner.
Yeah.
So all kind of going to plan for him. But I think just talking on this theme, the Russia-Ukraine thing has, revealed itself again, right? This was yesterday in particular, that the same thing you're saying, Martha, like you have the tweet and then it's things behind closed doors. But either way, they're getting back to it now. Will the market pay attention? Does the market care? On the announcement or the tweet or the social, whatever it was, I think flat price came off like 60, 70 cents and then it bounced back again. So that fatigue and headlines is just so there. But having said that, like if Putin and Zelensky are going to actually talk, or there's going to be evidence of them actually talking, and if there are things leaked out to the media, I imagine it's different this time because it's no longer Trump saying it, it's actually the two. People
want to see, whenever Trump claims anything, I think now, like you say, with the headline fatigue, people need to see like concrete evidence that it's actually happening. Yeah. Like the sort of discount to any of his statements now is just getting like so big.
The Trump tweet discount.
I think you can also extrapolate.
It used to be enormous. Like the reaction to his tweets used to be just insane, and now it's just like
it still will be if it's something new. But I guess it's all the same stuff. But I would extrapolate what we were saying before, which is if volumes are normalizing, volatility is normalizing, risk is normalizing, then you're not going to jump onto a headline because I think why does volatility happen? Because either someone's desperately trying to get out of a position or trying to get into one, right? That's ultimately how it is. I think there's no rush to get into our positions right now. So it's like, okay, well, let's see. And that's just a great kind of like sense of the market's, the feeling right now. So it's not going to react to anything unwarranted. Having said all that, we have got little snippets of the Iran deal clearly not having too much of an impact on the outright price because it hasn't really moved much week on week. But NAPFA that we thought would move has moved lower. Brent Dubai has moved higher. These two things are structural, right? So, Dubai crude should get softer, more supply. NAPFA is because it's the proxy for condensate. So Iran produces both Dubai-related crudes and kind of condensate-related crudes. So for those to weaken in line with the Iranian moves going on, does indicate that there is something on the underlying physical market that could slightly give way. So that's something to kind of follow the trend on, right? And we still think, and I think we need to go over this later, these are trades we've been talking about for a while, short NAPFA crack, long Brent Dubai, and they're playing out quite nicely. And I think if you're looking for that like trending trades, there are a few now that look like they're being pieced together. But anything else on the herd mentality we need to keep an eye on?
Just the last thing. I mean, I think we can't really not mention the Moody's downgrade for the US credit score. Obviously not my area of expertise, Macro Mondays. I think I would have covered this very well, and probably the boys and the officials will as well. Also poor Chinese data. I think it's just kind of like confusion or uncertainty about the future, because I've seen people online saying, this is the end of the dollar. I'm sure if Jorge were here, he would say the dollar's collapsing and everything awful. But in terms of actual reality, the impact this is going to have is probably small right now, and like a large impact on long-term borrowing, stuff like that, which we're not seeing the immediate impact right now in the oil market.
Okay, great. But you're right. It will become a theme when it's relevant or when there's volatility and people need a story. But either way, we've also been saying that actually some of the main, not herd mentality, but the interest in the market is in the underlying industry and the physical market, the spot market. And we've had some volatility in the spot market recently. And I think that's a good time to pass to the officials who will talk more on that. So this is cross to the officials. Hi, guys.
Thanks, Greg. Hey, how's it going? So, yeah, as you guys have mentioned in the studio, the Iran question is a big one at the moment. And if you get a relaxation of the sanctions on Iran and therefore see more Iranian crude coming back to the market, let's remember Iran produces around 3.5 million barrels per day. And if the sanctions come off, it's expected to increase even further. So Goldman Sachs, for instance, thinks that will be over 3.6. And then near 2 million barrels of that every day is going to China, because China's been this lower buyer. So
especially on the teapot side.
Yeah.
They have quite a sophisticated, complex refinery sector in China, which is very good at processing kind of your more medium sour, slightly heavier crudes. But those teapots have been under considerable pressure already. So like Shandong independent refiners, for example, their run rates are down to like 51%. While state-owned refiners are up near 77%.
Mm-hmm.
So further pressure there could if we see Iranian crude and medium sour, if we see a little bit more
because if there's
price action in the spot market there, that could be
if there's more competition for these Iranian barrels, then that'll bring the price up, put some more pressure on those teapot margins.
And you also have to look at the broader medium sour complex as well. I mean, so with the recent sell-off, we've seen Urals kind of price under that $60 price cap. If we see structures relax, if we see further bearish price action there, that could open the door up for that continuation of Urals clearing into Europe. So the price cap essentially
is redundant, right?
Redundant, yeah. So I mean, really, kind of the key market to watch here is your Dubai, your Dubai spot market, because the benchmark medium sour. And I mean, really, we've seen
that,
right?
So already the physical premium in Dubai has been steadily declining for the past couple of weeks. Really, it's now down to $1.07 as of yesterday.
Yeah.
So clearly, there is traders are pricing in this weakness in Dubai with probably additional ease of access to these Iranian barrels.
Yeah.
And then in the window, it's still quite a limited buy side.
I mean, like, well, it's a similar story broadly in terms of participation. PetroChina remains the key seller here. Key buyer. PetroChina remains the key buyer here, and Vitol, Gunvor, Exxon, key sellers, as well as North Australia. So it's more of that same monthly structure in Dubai. You rarely see kind of players flipping sides halfway through the month. They tend to get
And then if we're looking back at the Brent Dubai, which you referred to as a key indicator of the sentiment about the light sweet to medium sour kind of complexes, the physical window in the North Sea has been really, really weak recently. Kind of a physical diff down in the negatives, even as low as like minus 48 cents nearly. But as of yesterday, it suddenly jumped back up again, got a lot stronger with some buying interest. So there is certainly this scope that we've been talking about for a few weeks in the videos on Flux News and on the officials videos and our reports about how Brent Dubai can strengthen considerably on that basis.
Great, thanks guys. I think it's that recurring theme of as you say, how the Dubai market is reacting to the geopolitics and the shifting physical flows, and then kind of data Brent independently that's off, seemingly local refinery economics, which makes sense. And we've been saying the prompt refinery margins are incredibly strong. And so the crude market locally should be responding to that, because ultimately they are the buyers of that crude. And that is starting to come into play, right? We've had this bounce back, really good buying, and conversely, not so much good buying in Dubai. And your themes about China, makes sense, right? They've done a hell of a lot of stockpiling when the price was lower, kind of 60 on Brent. But, consumer buying and consumer hedging and storage buying, you can't last forever, right? So that would make sense. That's been and gone. And now we're kind of like looking at the lay of the land and where do we go from here? But the good news for traders is, traders want some certainty in the trend. And I think that kind of Brent versus Dubai trend going up actually makes sense, both in the physical market, the sentiment market, and the positioning market. And it does seem to be heading that way, and that normalization of kind of Dubai markets in the long term moving into more of a discount to the wider Brent crudes. And that should normalize the shipping routes, and even the Suez Canal situation seems to be improving. So the whole oil trading world from a spot market perspective does seem tentatively like it really is going back to normal after, 4 or 5 years of chaos. But we will talk a lot more about refinery margins, which is a new theme, but we're going to do that in a few sections time. So stick around, but thanks guys. Now we will look at the hedge fund watch. Okay, so hedge fund watch. of course, this is about how the hedge funds have been trading, their positioning, any news and rumors we've been hearing. So Martha, I guess starting with positioning, you kind of mentioned at the beginning, but generally speaking.
So yeah, we've seen a bit of a divergence for the CFTC data between Brent and WTI. As I said earlier, in Brent, money managers added about 22% to their length, but in WTI, money managers removed both long and short interest, and there was a more significant decrease in overall open interest across the whole curve of about 1.7%.
Okay, and how does that coincide with the CTAs? So I guess this is now the modern way of looking at this report, CFTC report, showing all the positioning changes, open interest changing, but then the most interesting one is the hedge funds, right? Because we know that they have to ultimately close their positions, and they roll them, they keep them live by rolling them, and it's not a hedge. So ultimately it will always move the market because they have to shift the positioning from short to long. So when we look at the managed money, we're saying, okay, how much of that is predictable kind of CTA movements, which is a big part of the volume, which is just simple trend setting. Then you have risk parity, which is like the hedge funds or the money managers, like the asset management, who are buying and selling things based on risk parity, we call it. So that's, bonds, equities, commodities, how they're reacting. And I guess the most one for reflecting kind of speculative discretionary money is the one that's left over, right? So if we just go from the CTA, like how the CTA has been
so
moving.
The CTAs reflect, as you were talking about earlier when we were mentioning the themes, that kind of normalisation of risk. They remain negative overall in their net positioning, but they've increased from being more negative about 40% each week on week to yesterday, the week to yesterday.
Do you remember we were talking about this? So we felt that, I don't know, 4 or 5 weeks back, it was going back up to kind of 66, 67. And we were saying that this market's in danger of really blowing out.
It could be like a big liquidation move up.
Yeah, because of the CTAs. Mm-hmm. It didn't quite happen. And then this is the weird thing about volatility coming off. So it went to 67. We thought it could blow out. It didn't. Okay, it trickles back down. But if it stays within this tighter range and you delay it across a few more weeks, then the metrics that they're using for their trend following momentum, they could stay, the market cannot really move, but of course everything's normalizing over time. And if they're using 100, 200 day averages, then suddenly, because the market's higher and because that's now feeding into the 100 day or 200 day average, whatever it is, moving average, then that's now changing their positions. So it's weird, isn't it?
You start to get those like technical indicators that they look for, like trend reversals.
Well, we thought the price was higher, so the CTAs were coming and buying, but they're slower than that, right? They're reacting. That's what I'm saying. So now that the volatility's gone down, the price has stayed in the same range. Now they're buying back, which is kind of weird in a way, but the market isn't as sensitive. Yeah. So I think this buying back on just based on momentum, isn't really going to do anything. It's getting absorbed kind of long or short, like we said. There's normalization coming in. So personally, I don't think the CTA impact is going to be significant.
And they're probably like pretty relaxed as well in the way they're liquidating. It doesn't, like, the volatility has not been strong, so they're not like stopping out or anything. They're not going to just be like, ripping the market just to get some volume off.
No,
probably
definitely not.
Probably quite chilled.
Yeah, so I would say that CTA is going up 40%, but over the overall not going up as much as that. That's basically it, right? So then you can't really say anything about the sentiment change. You can't say anything about the hedge fund community going for their dinners, their networking and being like, we're really bullish. That's not the case because it's getting swallowed up by the movement in CTAs. If anything, it's the opposite, right? I mean, you've had de-risking in the US contracts from the hedge funds there. Probably sounds like de-risking from more the discretionary funds in the UK and Europe with the Brent contract and maybe Asia. So that's it really. They aren't really that involved or moving the market very much. And I guess that ties in.
Yeah, I mean, when you said we're going to look at headlines, it was hard to see any significant headlines in commodities. I think there was strong buying in US equities. Goldman Sachs came out and said we saw the most substantial net buying since December 2021 in US equities, and primarily short covers, they say, but also there was some long buying. There was some long buying too. And they were saying to everyone to buy the dip in the healthcare stocks, if that's a tip for anyone.
Well, yeah, I mean, from the hedge fund perspective, we could talk about the risk parity side of things, right? So we pretty much all of us, whether we know it or not, have some kind of exposure to these asset managers who are going to be buying a portion of bonds, equities, like I was saying, commodities, and they just have their regimes. Like, are we in a high inflation, low growth, whatever, stagflation environment? Are we in a high growth environment? Things like that. And I think it does seem anyway, like a lot of funds wanted to be long oil, long commodities, as well as being long equities and kind of or low weight bonds and things. That was the kind of, whatever that regime was, that seems to have changed. Like you said about Trump keeping the lid on prices. I think the risk parity investors are probably underweight long oil now. This is not really the case for inflation like people were really worried about before, especially with the dollar. Well, actually, doesn't make sense. The dollar weakening probably would help inflation, but I don't know how much certainty there is around that. But generally speaking, it doesn't look like there's a huge appetite to have commodities on the portfolio long like there was at the beginning of the year. There was a bit of fear of the inflation sign lasting.
And I suppose, especially in the last couple of weeks, there's been the real stories like that one there about, pushing into equities. Yeah, maybe they just see there's more opportunity to kind of buy the dip in equities or whatever.
But again, if you were talking to a fund manager who's managing your retirement, right? I mean, you have one as well, right? And I don't know if you speak with these guys, but generally speaking, I think this move 74-ish down to 60, we're talking like it's mayhem and, there's always volatility. But I think to them, it was kind of like, maybe to some extent for some of them, quite a predictable shift or cyclical shift down. And if they're expecting it to be higher, they're like, okay, well, the regime's now changed and that's a good indication. It's not down to minus 37 like we got in 2020. It's not even down to stupidly low levels. It's quite an orderly shift, I would say. So maybe that just says, okay, well, we've reset things, the ceasefires for the gas prices, the power prices. That just means we are now in a low inflation environment. Maybe we can shift things around. And I'm just going purely off what I'm hearing and seeing it. And I guess the volumes, there isn't that fear of inflation, which usually brings in a lot of buying in oil. And I think to tap it off, any stories going on, I guess you're hinting at this last thing you've got, right?
Well, yeah, we're saying about the commodities, there's not big traders, but in China, there's a billionaire, Bing Jiangming, and he's made loads and loads of money on gold before, and he's bought lots and lots of copper, again, bullish copper.
Yeah, I think this was a Bloomberg article, right?
He was long. Yeah, he's built like 100 KT long in copper or something.
Yeah, is that big of a...
I think on a flat price basis.
Yeah,
it is.
Okay. All right, well, yeah, I mean, the copper trade has been around for about a year, I would say. And that transition theme, copper's going to be really tight because of creating electric cars and this kind of general macro theme. He's going in on it again. I don't know, prices have dipped quite a lot. Maybe it's just one of those things. It's just buying as perceived low. I got no idea.
Yeah, I saw, I'd be quite interested to see, there was like a graph I've looked at the last couple of years. It's like the commodities versus equities, relative pricing. And I know that like a lot of people were looking at it was like historically commodities are like very as cheap as they've ever been against equities. And I know that like that was a lot of people were buying like these kind of metals against that. I mean,
we know that Under Armour's had a pretty tough time. We talked about that last week, and we know that he was invested in copper as well. So that general macro trade that caused a lot of hype last year is unwinding, and then looks like he's just thought, actually, no, I think it's a real thing, and the reversion to the mean, if you like.
Yeah, because there was some hysteria around it when I saw there was some like bank analysts being like, this is like the trade of the decade and stuff. And then obviously that tends to be a bit of a signal of a peak hysteria moment, and then things like copper did come up after that. But do
you know that bubble graph looked at a million times? It's like the kind of from the tulip days, and it's just a great graph to represent like hype times, right? And I think copper would have gone through that, and it labels each part of it, and it's like that whole basically greed and media attention and like enthusiasm hype. It crashes because it's just so overweight. And this is the thing, right? When everyone's talking about the market being bullish, the people that should be selling don't even sell. The hedgers who provide liquidity. Like the shale oil producers in 21 and 22, they were like, why would we be selling?
We should be buying 110 Brent.
But the CEO came out and said that. He's like, what are you talking about? All the banks are saying buy. Why would we hedge? So that really doesn't work, because it means that the natural way of things is in the liquidity and the dynamics completely break down because it's only buyers. So inevitably you do get this crash. It just fundamentals go out the way, and something triggers something on the exit door, and then everyone clambers down. But what I was getting at was, when you see this classic bubble graph, you do look at the very end and say there is eventually a leveling out, a lowering of volatility, and they call it the reversion to the mean. That is something that I think you can trade. I mean, it's a bit like it's always happening in contracts, even like the Brent Dubai. Like we went from like the negatives, boomed all this hype of Iran and OPEC producing more supply, scrambled up and scrambled down, and now it's kind of steadied out, lowering volatility, and it's on this nice trend. I feel like that is the theme of everything right now in a way. Like many contracts are experiencing this lowering of volatility but still trending. It's not a lowering of volatility, and that can be really bad because it indicates that people don't want to trade and they just don't know what's going on. I don't think that's going on. I think people are like, oh, fine, like it's actually calm. I've got a relatively calm and relatively high conviction view on where things are going now, so can see this through in an orderly way, and that would just make sense for all the equities and all that. But copper, maybe it's the same. You've had all that hype, we're leveling out, and the guy's like, what's a good time? It's still structurally the same story, just all the hype's gone and all the I don't know, something like that.
What does the headline say anything else? Is there any juicy parts of the headline? I know it's just that
no, they talk about how great he is. He made a fortune in plastic tubes. But
you can
a bet worth nearly $1 billion. So I don't know what that is in weight.
Yeah,
notional value. It's a hard one. I mean, it's interesting, but it's not.
I feel like I saw somewhere that it was like 100 KT, or don't know whether that's different because it's like the physical stuff. Obviously, for us, 100 KT is not insane size, but
no.
I feel like I saw it somewhere. So if I'm wrong, sorry.
Okay, so that was the hedge fund watch. Now we're going to introduce a new section on refinery margins. We're calling the crack spread Chronicles. Okay, we talk a lot about refinery margin economics. This is just the product prices minus the crude prices, the feedstock into refiners. Really important metric. Refiners making a lot of money, they buy a lot of crude. But also there's more nuances in that because the different types of crude you can buy or what's being supplied can lead to different product yields, and it's indicative of supply and demand of these individual areas, regions and products. So it's a very interesting area and a big driver of the market. And we've been talking a lot, haven't we, around refinery margins, because we noticed on the back of, the end of the volatility that started with Trump and finished with OPEC, had caused some dislocation. So one of the main ones has been the refinery margin in the prompt. But you've got this situation where the refinery margin in the prompt versus looking at the refinery margin down the curve is backwardated. It's a lot higher in the front. So it's all just indicative of either localized strength in benchmarks or just a time thing. Just right now it's high. But it was getting to that point that it was dislocated. And actually Manny and James on Trading Corner, you can check that out on YouTube. That's live, well, not live, that's recorded on the trading floor. And they love looking at this one we got back here, which is the refinery margin versus the DFL. So the DFL is basically a reflection of the physical diff, right? Positive or negative would kind of give you a general indication of the health of the North Sea market. And that tends to go up when refinery margins are strong. And you noticed at the beginning of May, towards the early May, it was really the DFL was moving down, the refinery margin was going up to the point where refiners are making so much money locally and their local data Brent market just didn't seem to react. I will put that down to essentially, well, a number of things, but for sure one of them is just too much hype, too much length going into previous expiry. There was a lot of exuberance, a lot of money being made actually. Mm-hmm. And then possibly just as we got into the beginning of the month, a bit of an unwinding of that and taking a step back. But it was more we were looking at, weren't we? How can fuel oil cracks be so positive for so long as a waste product? Naphtha was holding up. Gasol had a recent strength that we talked about last week, and gasoline's been rallying all year. So it was just getting a bit ridiculous. Yeah. And not that we're prescient and all that, but since we talked about that last week, refinery margins take a big hit, and you can see that a big correction, and actually a big correction up in DFLs. So it's a very logical move there. Mm-hmm. That crude should move up locally if they're making so much money, and if it's being produced, you convert that kind of supply that's out there in crude into supply of products, and naturally it should come off. So that all in all was logical, but I think we need to talk about it a bit more broken down. And I would say, speaking to our fuel guys in Onyx Commodities, reached out on the group and said, Greg, this is interesting. We're talking about possible fuel market being over long now. Consumer hedging up the wazoo, long shippers, all that. Speculatively long, people making a lot of money. Yeah. But everyone just seeming like just endless buying. And we're getting towards summer where there's the air conditioning demand, the power demand, and you start to say, actually, you're kind of seeing I can't remember exactly what it was, but the market not really being able to sustain itself and starting to wobble. And as soon as he said that, like the distillate market started crashing, $1.50 down on that crack, kind of gasoline's come off a bit, but naphtha crack's finally giving away as well after being very stubborn. So that's just a across the board weakening that I bet you if you ask people's opinions on that, they would probably try and look for different narratives. But I think from our perspective, it's very logical. It's just an overall refinery margin thing. That's the best I can summarize it, I guess.
Yeah.
And anything else you've heard in fuel or?
No, I mean, I was actually talking to someone else yesterday about it, but, you know, just trying to make sense of not necessarily like the levels, but just like the sustained levels. We were just talking about, you know, various agendas, people making money, like people seeing that it's like you know, they've been able to sustain it, so they're trying to sustain it longer. But yeah, I mean, everyone I've spoken to about fuel is just like, I don't get how this is this high for this long, and especially when you've got a refinery margin environment like this, it's like
but that's really interesting you brought that up. That sustained prices create changes. Ultimately, so we talked about the moving average, you know, with the CTAs. You know, after a while of it being high prices, then it creates a change in their positioning in the CTAs. If you think about sort of refiners, it's all well and good having a strong refinery margin, but if it's not lasting, it's quite hard to capture and cause big changes to a whole big refinery operation. But when it's been strong for so long, and particularly the waste products and naphtha and fuel oil in particular, for this long, they're like, okay, well, I'm going to ramp up, and
this must be real, this is it.
And I can actually profit from it because I can start I can increase my utilization rates. I can buy a cheaper, heavier crude, run it, and actually profit from these refinery cracks that on paper look good, but now I want to realize it. And I think more and more refiners doing that. Finally, the market is kind of being called on it's bullshit, but it's can you sustain that level? Because a shitload of physical volume at this.
Well, you think so. I mean, it remains to be seen, but it's just
it is wobbling. I mean, and we said the Q4 crack in particular was one to keep an eye out for. And I think we'll review that in the next video. How that trade's been going, but I don't think it was ever a smart idea to necessarily take on the front because of what you're saying. You've got these agendas. People want to see it high. They've seen it high. And if they've now seen this wobble, I imagine what some of the larger trade houses are doing are going, okay, fine. It might be over now, but I'm still going to keep the prompt high as long as I can. I'm going to start selling the back end. Which is why it's always good to kind of look a bit further out for that kind of safety and volatility if you're going contrarian. A bit like how we chose Q4 for Brent Dubai because the front's mayhem, right? We'll choose something that's going to be a bit more stable and then see out the contrarian move there. And naphtha as well was very logical because ultimately it had been high for a long time. And on the backdrop of Iranian supply and general oversupply, weaker China petchem market, all this stuff, like it just finally makes a bit more sense. But I guess it's now like, how far can it go? Because the margins can still get weaker and still be strong. If they're profitable, refiners run. So I think we've still got a way to go.
Well, you were coming from a very high level and you're still at a high level. It's the same with the fuel cracks. I mean, they could sell off $3 and you still look at it and be like, well, I mean, the syn crack would be positive still. Almost. So, you know, you are coming from a very high level. So, in terms of how far it's got to go, if you then get into that kind of reset, like normalisation on fuel, I mean, that could be an enormous move.
It could, a long market and historical norms are a while away. You have quite high conviction of new shorts coming in and longs having to stop out. Is always going to create a big move. I think what I also wanted to say was when analysing the market, like at least in my time, and it doesn't always play out like this, but if the market is behaving logically, that's a time to be quite high conviction and get onto these trends. So what I would say is we're on the backdrop of an oversupplied market. That's what's been called for in the consensus. That's generally where we think the market's in. It's a bit oversupplied. It's going to be increasingly oversupplied, and the market's got to figure itself out. You know, the cure for high prices is high prices. So you can just sell outright prices, and that's what people have done. But when you sell the outright prices, you sell crude, for example, like Brent prices. When Brent prices have a big collapse and abruptly, you get a hell of a lot of consumer buying, new demand. You talk about the US probably going, oh, right, I can drive more because it's cheaper. You get more demand pushes like that, more demand from China from filling up storage, things like that. So again, coming back to the theme of this day really is like, it's about sustained low prices. So if you sustainably kind of reach this homeostasis in Brent kind of 60 to 65, but you're still in a state of oversupply. Well, shorting outright prices right now is not the best trade because you've kind of had a move down, but now you need to see the evidence of it playing out in the derivative curve, in the physical premiums, in all the products. You need to get your signals that there really is oversupply. So what do I mean by that? Well, if the refiners are making money, then they're going to be buying crude. So what do you need to do? You need to see that oversupply in crude that is allegedly there. You need to see that filter into products. So firstly, you need the refiners to come in and buy all that crude with the higher refinery margins on a lower price. They then buy all that crude, run it. You need to see increasing utilization rates like we're starting to see now. Then you need to see that oversupply that's in there in crude filter into oversupply in products. The product premiums need to weaken. The product cracks need to weaken. The refinery margin needs to weaken so refiners stop buying crude, because if it's oversupplied, then it doesn't make any sense for the product prices to be expensive, because that means it's not oversupplied. It means that they can keep buying and people keep consuming. So the next thing, I think, if you want to short this market, and full disclosure, like, I'm probably a bit ahead of it, like myself, and I'm not taking my own advice, but I wanted to be in the short position on the outright, just to kind of be in the trade and kind of scale in on the way down. But to get the highest conviction, I think what we need to see is basically a refinery margin collapse. And that means that the DFLs and the Brent spreads can stay strong. So if anyone's thinking, how is the Brent spread at 70? How are we expiring so strong? And how's the DFL so strong? Well, because they're buying the crap out of crude. But eventually that will feed into this weaker product premiums and weaker cracks. And we just saw a crack set off across the board. And if we get increasing conviction in that, then that should keep going. So this is the domino you wanted to see if you've got a long-term bearish view. So look, it's kind of playing out. And buying Brent to buy, shorting the cracks, and holding off on a high conviction outright short on Brent or outright prices until these fall. Like we've seen negative margins plenty of times in our time, right? 2014 was a big one, super negative margins, and then eventually the crude premiums getting negative. That's the final ultra. If the product premiums are bearish, the cracks are weak, and the crude premiums are negative, you have an unbelievably oversupplied market. The only thing that can happen is crude prices weaken. So that's just my summary of that. But a really important section of refinery margins. We need to keep this up. I think what we introduced next week is more like talk about the utilization rates, particularly out the US and maybe area what we've been hearing. But you got anything on that? I mean, for me, I have seen the stats come in higher on utilization from the US.
Yeah, I mean, the stats were a bit of a roller coaster last week anyway, but I think we saw over a percentage increase in the refinery utilization.
Which is huge, right?
Yeah, really, really high. I mean, why wouldn't they be?
Yeah.
And just going off what you were saying earlier, just to bring some news into it, bring a headline to say that Ryanair's been putting a lot of hedges out at the moment. I think the low flat price environment, I think this was kind of a potential theme in gas oil as well, as we were saying, like, why the hell is it so strong? We were seeing that kind of front loading of flat price in a low crude environment. And then I think that kind of prompts airlines and other players like that to put their hedges on as well.
See, that is fascinating to me because, I heard another big airline hedging a lot, and that's kind of what they do apparently, and whatever else. But Ryanair, in my mind, and what I've seen and looking at their quarterly reports and their behavior, they're very systematic. And I've always commended them for that, because by being systematic and calm when prices are high, prices are low, they have benefited very well. So a lot of airlines rush in when prices are high, and when prices are low, they
don't do anything.
They don't do anything, and they've lost a lot of money on their hedges, and they don't benefit from the low prices by. The only way you can benefit from prices going low is continuing to buy. And they didn't, and most airlines don't. So they lose on hedges, and they pay expensive fuel, and they don't really the system mess. But Ryanair don't usually do that. They usually benefit very much because of their systematic approach, and they're one of the standout airlines when prices really skyrocket, because we're hedged like we always are in a very systematic way. So for them to come out and say we're seeing strong summer demand and we're hiking fuel hedging seems to me like a going against what they're used to doing, which makes me think a bit of hubris is coming in, because they're clearing like their peers. They're doing very well. I think they might. I think I'm right in saying this, but I haven't looked. But from what I've read, they're doing like economically quite well as a business. That seems like a bit of hubris to come in. That we have to be clear, that is a gamble, right? If you come in and move away from a systematic, well thought out strategy because you're going, summer demand seems fine, then that is spec, unless you genuinely have an increase in
the ticket sales to go with it. Yeah.
And that's fair enough.
Yeah.
If you genuinely are just off the back of more physical buy hedging, well then fine. But it's the way it's put, at least, suggests that they're moving away from that, but that'd be interesting. Cool, great. Really important section, like I said, but let's move on. So now we need to talk about winners and losers, and we're starting with the gold rush. So we've done with the gold rush some niche contracts lately, but I think it's important we talk about more generic contracts, the ones that have the highest volume in. So Martha, what are you thinking?
I think this week it's Brent spreads. We've seen a strong week or so. It's rallied from about 35 cents to 70 cents, which is pretty stable at now. Touch wood, I've had no crash this morning.
Yeah.
And I think players are kind of happy to see that trend up, and we're buying into it. And it was just a nice gold rush.
Yeah. I think the previous expiry, a lot of money made on the way up. I think probably maybe too many people held it into expiry. It was a bit of a dicey time, maybe gave back a bit, but still generally made money. Then it felt like a bit of a flash in the pan with that Brent spread, June, July. And now July, Aug, it was looking, I mean, we were bearish it last week. We felt like things were changing. But again, the buying all came in on the refinery margins that we don't know exactly why, but that would make sense. The physical premiums, like the officials guys, have come back yesterday. Probably the North Sea club, if you like, 5 or 6 of them that tend to have disproportionate volumes as a contribution of the overall Brent spread volume. They're probably bullish, and they probably see, this has got to repeat from last month. They probably like that there's a bit of fear in the market from being long, because that means they can take the buy side, sell side liquidity, they can take that on, and it's not a crowded trade.
Yeah,
kind of makes sense that it would be bullish. I mean, I wouldn't say I called for it, but it kind of makes sense on retrospect. So I think you're right. I think the orderly rally there and decent move suggests they probably did make quite considerable money. And if you had to estimate it, an average price probably entered of 35.40.
Yeah.
And if they're able to crystallize that on expiry, and when it expires 35 cents, that's 35 cents on, these guys on a one spread can hold anywhere between 50 to 100,000 lots. And if you times that by, 5 or 6 of them doing it, you're looking at, roughly probably 200-300 million made on this move in the industry, which kind of makes sense. But you got to weigh that against the backdrop of what's lost on physical. But at the same time, what's been made in the data contracts maybe as well. But yeah, that generally makes sense. Anything else? No, I would say the market hasn't really been pricing in this sell-off in margins. So I know we're talking about who's made money, but I think it was probably been a general market for not making a hell of a lot, apart from maybe the NATFA cracks, because we've been talking a lot about the industry being short NATFA cracks, and they're not really weakening, but has started to come in. So I'd probably add that to the mix as well. Okay, now to the losers in the last week, and this is the widow maker.
This week we're looking at European gas oil. It was really, really strong. We had front cracks of nearly $20. It was driven by US fundamentals. Stocks in the US really, really low. Draw last week in the EIA stocks of like 3 million barrels, which isn't seasonal at all. Everyone really shocked. There's not an obvious reason why. It tends to be quite macro driven, but there's not, crazy trucking demand or crazy farming demand that really, it seems just kind of incongruous. So we've seen money managers from CFTC building their long positions by like 20% for 2 weeks. CTAs building their length as well, still minus, but kind of getting rid of that risk. And then just a huge crash, as you said earlier, $1.50 lost in the front crack and some widows made.
Yeah, I think that's for sure. Some widows made is a good way of putting it. I think on the backdrop of seemingly a trend to buy into, like the CTAs, and a story to buy into, fine. We didn't really pick up on that. Last week we felt we were at a loss as to what the story really was. But either way, should really have said this in the previous section, but we have seen a lot of evidence of refinery margin hedging coming back in. So we saw it at the beginning of the year. And do you remember we were talking about how the margin hedging was probably done a bit lower? So the fact that prices are higher means that the refiners are kind of have given away a bit of potential upside to really like run their refiners at a high rate and profit from these margins. But they were coming in droves in the last week. And when you're selling across the board, like something has to give way ultimately. Yeah, DFL's had a big spike, and the gas oil crack volume just shows like that selling volume coming in, and it is the meat of the barrel, right? The gas oil is the biggest volume produced by crude generally. And so it just looks like it couldn't hold that volume. And I don't know precisely, but I would wager that that flow was just too much for the market to take. And possibly in a backdrop of an oversupplied, weaker macro environment market, gas oil tends to be a proxy for economics, right? So the fact that there was longs were probably fickle longs, probably buying on what they've heard or trends, which means they're quite scared when new selling flow comes in and they run for the exit.
Yeah. Particularly if they took on some of that hedging and then saw more of it maybe. And then it kind of, like you say, if they were thickly initially buying into it, and then if there was kind of some decent volume being hedged on cracks.
Yeah, and it's the timing of these things, right? Because you could probably say, I mean, Ryanair saying they're hedging, I mean, they probably already did hedge. We know there was a lot of airlines, like I've said, I've heard as well, coming in and buying in droves. That's going to impact the distillate crack because it's jet fuel. You might as well buy the distillate crack and buy the jet diff if you want to, and it's very, very close in price. So ultimately, yeah, that huge amount of buying happened maybe weeks prior, stopped, and now refinery margin hedging came in. So it's like you propped up the market, given way, and then new selling. So ideally it would have matched off, and then that's why you need market makers. You need people to hold the risk and bridge between the huge buyers and huge sellers. And it's very uncommon that they match each other off all the time. So that's maybe just a bit unfortunate for longs. They, didn't see that flow, thought there was nothing in the way, and then all of a sudden there was, and there wasn't the airline hedging that has been there to kind of support it.
Yeah.
So that's a good one, Martha. I think we could probably say that's for sure where the market is losing money. I would add to that, one to keep an eye on is the fuel market, right? But I think that's we need to.
Yeah, well, I mean, we brought it up multiple times as a gold rush trade, but yeah, I mean, we know that the market has been pretty stacked long. So yeah, if we get a good correction, that might be quite a juicy widow maker for 1 week.
Okay. So we talked about the normalization themes, talked about general themes in the market. Let's get a bit more of a sense of how that's impacted more of the niche market. This is the deep dive. So what are we looking at in the deep dive, Martha, and the research team?
We're looking at Asian propane. So this is kind of a deep dive in to see how the market is looking after a lot of macro news happening in the market.
But let's give a bit of context to this. We've talked about propane here and there whenever we talk about tariffs, because retaliatory tariffs from China on the US was what we were expecting this year the Asia propane benchmark would be most impacted of all contracts on tariff news because they import such a big proportion of the US export of propane, which they just don't really need, and they export just so much of it. So the arbitrage differential is always negative, and it's always either negative or super negative, and to incentivize flows. So the FEI benchmark is on delivered, right? So it's on delivered US. So the fact that the fact that there was no oil coming in because of the tariffs, it just weakened a considerable amount because I guess to offset the tariff amount, the amount had to weaken to allow for that tariff. And then the FEIs, the Asia benchmark versus the Saudi propane just went completely out of whack. And it just caused a bit of mayhem. And I don't think people have done very well, apart from the physical guys who buy on an FEI basis and who sell domestically on a CP basis, like South Korea, like Japan. They've been loving it because they've not been impacted by the tariffs. Like China, they buy the propane cheap, that's delivered from US, and they sell it locally at the CP price, which has been held up. So those guys have made money. But I guess just given the backdrop, because it's a big macro theme, and this is a good example of how people don't know about these global oil contracts and how important they are to reflect global economics. And there's nothing in the global economic world or headlines will ever not touch a contract. So you can always get more indication of how the economy is really really being felt, or the impact really being felt from these tariffs or any of these economic changes by looking at these niche contracts. So that's the backdrop to lay you up, Martha, for Asian propane. But yeah, C3 FDI.
I think just coincidentally, this kind of matches to what's become the theme of the episode of normalization and kind of rebalancing. So we saw, as you mentioned, that this being hugely impacted by the tariffs and reciprocal tariffs. As you said, the Chinese exports, 60% of Chinese LPG and ethane exports are from the US, which I had no idea. That's just crazy. Anyway, so we saw this drop in open interest from mid-May, and just to show the entry levels from long positioned players were in the money here, and we saw trade houses and a few majors short positions.
So this is
over the month as well.
on the outright price.
This is on the outright.
So I think with propane, the outright price is traded a lot more than other contracts. The other products are so tightly linked to crude prices, so there's no point really trading it because you might as well just trade Brent. But with propane, it's different because it's only kind of 30%, roughly 40% hedge with Brent. So genuinely, people buy the flat price or sell the flat price to reflect their view. So that's why it's relevant, I guess, to look at the outright price. But you're saying they've been making money, generally speaking, from...
So they closed some length in the higher prices, but just looking at the rebalance market now, they still remain long. So they still do hold quite a lot, I think over 1.2 million barrels of length in the June contract.
That's with us, held with us.
With us.
Yeah. So I think... that's interesting, but generally speaking, if you look at the FEI versus CP, let's say, we can get that up later. That's probably a more interesting graph because that should really track the Saudi propane prices, given the proximity of the region, and they do, and it goes kind of yin and yang, but within a certain range, and that blew out and has come back, and that comeback from the FEI versus CP definitely reflects the normalization. Then on top of that, I wonder if there's anything to be said about the FEI or Asian propane in general has been weak in the last year and a half, a lot weaker than usual. And these roll-up trades that have always worked, people in the market put on, they buy FEI or in the deferred when it's cheap, and they like to see it go higher when the demand comes in from China all of a sudden and it's very aggressive. Just hasn't been there for 18 months. So I wonder if the return to normalization and the general return to economic demand and stuff we've been hearing in China about them trying to promote way more of the bigger national refineries taking over some of the small independents. I wonder if the competition there is actually starting to eke out some of the huge amount of petchem producers they have, which maybe means the petchem margins can improve. I don't know if there's a narrative building that means that they can sustain this length and actually, rather than just see a normalization trade, it can kind of trend higher towards more 23 previous years, if you see what I mean, as opposed to last year, which was a shocker for propane, and all the correlations broke down. Anything else to add on that?
No, it's just a really simple one, to be honest.
Okay.
Looking at that normalization and people making pretty a good amount of money on Asian propane, which has been quite unusual, as you said.
I think again, listeners will probably think propane, what the hell? But it is interesting. There's money to be made in these differentials and even the flat prices. It's actually the US, funnily enough, the LST contract, so their export contract for propane, or their benchmark there, that actually does have a retail presence, and there's a lot of people who like trading propane, the LST contract on the CME exchange. So it's not like this would be new for them in the US, and we do have US listeners. I mean, they genuinely care about propane. It's a very domestic used oil. It's it's probably similar to how the Germans look at heating oil. They care. So I think to participate in that market and to look at that market is worthwhile and interesting. But anyway, thank you for that. So now we'll move to looking forward, and this is the crystal ball. Okay, so we've been, since the beginning of this new format of the podcast, tracking a group of contracts that we think reflects generally what's going on in the oil market, Brent outright, Brent time spreads, gas oil crack, and EBOL crack, so the European gasoline. We've actually been tracking our performance, and I think I'm the clear winner. You
are, yeah. And the geek and you are drawing now.
Yeah, I did have. I need to I need to check some of these results because
I do it.
there's 2 weeks where I was flat, and I'm pretty sure that I haven't had 2 flat weeks. So I'm going to do some reconciling after this.
Yeah,
but I think you're still in the lead.
You can make your own Excel sheet. You can't.
Yeah.
The point is, it is a bit of luck of the draw, of course. A lot of guesswork with these things, just binary up or down week on week. But it is useful to track this, how, you know, the themes of what we're saying and kind of how we're looking at the market generally and how that's playing out really in the market. You know, sometimes you can use guys like us as reverse indicators, and certainly there's research businesses out there that you think, no, you're genuinely always wrong. And there's kind of a reason why they're always wrong, because they're trying to support the Saudis or OPEC, and so they're always bullish. That's probably 95% of journalists and energy researchers. But some of the more like liberal, just kind of trade view people, where are they getting their narratives from? Like we have, you know, agencies popping up that look at things like arbitrages, and they think, you know, the economics and the difference between regions is actually a big indication of what prices will do. That's their lead way of taking views on markets. I would say ours is more flows and positioning. We're always looking at what traders are actually doing and trying to formulate views off the back of that and the backdrop of the stories they're buying into and the risk they're taking, the open interest. But then people are very also very physically driven and supply and demand driven. So I think it's useful to track these things. This is how we're looking at it, and this is how we're performing. Anyway. Let's go through the contracts for this week, and I think starting with Brent flat price, if you can get that up on the screen.
Yes.
Okay, so you've technical charted that up. We've said it's lower volatility. That kind of plays into the technicals as well, right?
Mm-hmm. Yeah, I mean, really flat. Looking the moving average, what is that? Even the 20-day really flat volatility, as shown by the Bollinger Bands, which take into account standard deviation of prices day on day. Looking at the week, I mean, we've seen a tiny trading range throughout the days. It's pretty hard to call, to be honest. Which is why it's important to look at momentum, which is the chart underneath, is the MACD histogram. You can see that this is still green, although it is decreasing a tiny bit day on day. There is still bullish momentum in the market.
You can see now, looking at this, why the CTAs have been buying, because it's actually something I remember Vincent as Geek in the Sea was saying, that 200-day moving average. That is the middle line, right?
That's the 20-day.
Sorry, 20-day, I meant. Yeah. 20-day. That was a really good resistance for a while.
Yeah, you can see it's been support this week.
Yeah, so that did break through. So I imagine that was a big indication for momentum signals to shift bullish. And the buying did come in. But we've now struggled to kind of move much beyond that. But having said that, we have broken that. So that's interesting, actually, and I think there's enough news out there for it to go either way. But we are weakening volatility still. So this is a really hard one to call. But I think we were bearish last week, generally speaking. I think, as I was saying earlier, the dominoes of what's going on, the refinery margins finally coming in, the new kind of people don't have to protect any positions so much, maybe apart from fuel now. So I would say a fresh kind of risk appetite, fresh look at the markets for the rest of the year. I think it's still skewed bearish. I think we still see positioning coming in short.
Yeah, and on balance, I just feel like this US Iran stuff is, for now, seems relatively.
Body language is like the personifying the market sentiment. It's just like it's bearish.
Yeah.
Low volatility and bearish.
Yeah, low volatility, bearish. Yeah, it just feels like on balance. That's just feels like the right way to be.
Yeah, I mean, you have clients as well, right? I mean, what are you getting from those clients? Retail clients, corporates?
Well, on flat, I think like with the corporates and retail, I mean, people just like corporates, especially, they tend to be quite reactive to things. But I mean, I think like retail still generally seems like
quite
bearish.
Constructive. Oh, bearish.
So
okay.
I've not spoken to loads about it, but yeah, I mean, from what I've spoken to, people are still relatively bearish.
Okay. So the themes that are out there, I mean, you have to go off that, right? Well, generally what we're seeing in articles and research agencies and banks is towards the bearish side. I mean, Goldman's have their $60 forecast, don't they? And they reiterated that. Am I not mistaken? You're looking at me like I'm crazy.
No, I was just thinking.
Okay, yeah.
Sorry.
No, but isn't that what Harry?
Only they changed it like 3 times in a week when all the news was coming out. But I think it's around 69.
Yeah. Okay. Any other take on this?
I mean, in all honesty, if it was an option to say flat around 65, I'd say that. I think before a breakout, we tend to see volatility like go way down, like the Bollinger Bands kind of pinch in, but these are just like running parallel to each other, which is just like, it seems almost like people are happy range trading here. I don't want to call for like a massive sell-off, even though I think I'm bearish overall. I'm going to say it's supported at 65.
Yeah, that's a very cheeky thing to say. But that means you're bearish because we're higher than 65.
Yeah, how do we benchmark that?
How do we benchmark it?
How do we assess that for next week?
If it's over 65, then I'll get the point.
Okay.
That's cheeky. Well, anyway, either way, I think, what you said about the pinch points is very interesting. And when you're trading volatility, right, you can trade options, buy calls, sell calls, and obviously vice versa puts. But you can also just range trade, because range trading is like mean reverting prices is a short volatility trade. And so I agree with you. I think there's probably more of that, which means it kind of becomes a reinforcing thing, right? You know, you get to the extremes of these ranges and you get the flow in. So I imagine it could be quite a stubborn technical market for a while, whilst people aren't reacting to headlines like you said, Harry, or not so much, and people are really getting increasingly confident to mean revert these things. So I kind of agree, like we have to see even more of a decrease of volatility to then set a new trend or a breakout, let's say, either way. Okay, that's a good one. So the Brent spread, the front time spread, July oil Brent, we talked about people making a lot of money on that, being long. I think we're late to this. We were bearish, and I think you have to give it to the market that the story is in line, right? The refinery margins, now the spot market moving up, and you kind of got the trend. It's probably now been and gone the move, but I don't know. I think being now expiry into the theme, what are we basically a week or so away from expiry? I wouldn't say, well, actually, we'll know in a couple of days as people start to liquidate pre-expiry a week before how the market takes that. But I think generally the North Sea players have been happy to take on sells, and it kind of caught the market a little bit unawares. So I think it keeps going, I think, personally.
I think another interesting thing to say, sorry, it's removed all my scribbles, but you can see we've got a series of lower highs here. So we have, when I can draw on it, see, I'll add it in post, see a kind of downwards channel forming here.
Fair enough.
So I think the levels that we're testing today will be really, really important, because if we see a close above this and then a good move higher tomorrow, then we can say, okay, this is broken. Or if we break way above it and don't, correct back down, it will just be really interesting to see that. I think today's a good day to be looking at this, because we're basically testing that upper level of the channel now.
No, that's well thought through. And again, I think we can keep saying that the market should be driven by technicals now with where we are, and low kind of conviction on huge breakout moves. So I guess you'd say you're bearish on that Brent spread.
Yeah, let's risk it. Yeah.
Okay. And so what did you say, Harry? You just stuck in between.
Yeah, I'm still. I mean, that chart. I was thinking.
Just say if it's above flat, you win.
Yeah. If it's between flat and $1, then I'll get a point. Yeah, I mean, looking at that chart, like you say, it's quite convincing. If there's been like a decent move, yeah, I'll take the other side and go bearish.
Okay. Right, moving to the product cracks. So I think gas oil cracks the one I'm keen to look at, just because we had that unexpected move up, or maybe some were expecting it, but then an aggressive move down. So if we can just get that chart.
This is the Sing gas oil crack.
Can we just look at the gas oil future? Because I think the reason why I say that is because we've also been talking about having a long-term short gas oil flat price trade on that we'll review in the next video. But I think that's been a really interesting trade, because whilst flat price has been held relatively within a range, because the cracks have weakened, you would have benefited from that. Yeah. So that's why that's been quite a nice trade.
I mean, we can see how sideways the market was trending here. I think when we were looking at the Singapore previously, it had such a channel of sideways trading, which is just kind of like, speaking to our traders like we do every week, they said that people were happy to range trade in these areas. But looking this week, we can see, as we mentioned in the Widowmaker, there was this great selling after a pretty nice rally. Prices got to like 1850, and then two really thick, long-bodied candles, which showed like very confident selling.
Very confident. Refinery margin hedging would be my guess, but again, we don't know that. But I like the word, saying confident selling. That's quite a big deal, actually, because it means there was an unexpected flow the market wasn't aware of, and is now kind of stumbling over itself to exit as well if you're long. But then it just shows that there was not that price rise created a real opportunity for refiners, right? And then we look back at the refinery margin curve, that spike we had towards the end of April, and even that little spike we had again kind of towards mid-May, probably Gasol related. Well, Gasol would have helped a lot because of how much that Gasol yields relative to the overall refinery margin.
Yeah.
So the margin is very sensitive to these moves. For then, it to crash down is probably because refiners are like, okay, that's the last straw. This is a great refinery margin market for me. I'm going to go in and sell the crap out of it. So I think I maintain a bearish view because again, there's a long way to go. Gasol cracks being 16 even. This is still a high level. I'm used to levels 8 to 10. So I think with not a lot going on and an oversupplied market allegedly, I think we've got way further to go. So that's bearish for me.
Yeah, same. We made the argument last week when we talked about the Gasol flat price trade, and I just don't think anything's changed. You had that decent move up and down in the week, but yeah, I think it's still bearish.
All right, Martha.
I'm bearish as well. If the Trump big bill goes through, then there'll be a change in the biodiesel. The 45Z bill goes through or something. And anyway, there'll be hopefully more RINs, more biodiesel, weaker heating oil, weaker gas oil.
Nice. That's a high conviction for you. Not trying to get a cop out. And all right, the final one is the European gasoline crack. I think, again, what's really surprised me about this market is we had such a run up and we were calling for it week in, week out, right? That the gasoline cracks, good place to put your money if you're bullish, riding those cracks up. And we got a really, how do I put this? A really mature market to go, I'm not going to take the piss here. Made my money, going to take it off. The open interest declined considerably. It just looks like people have made their money, taken it off the table, and that's it. And it's almost like they're leaving gasoline alone, which is kind of weird because Q3 is always the hyped up quarter, and people are just not interested this year in taking a chance. I
wonder if some of this, I know it might be a bit far-fetched, but I wonder if some of this is the kind of absence of some of the funds that were there the last couple of years who were just piling in based on nothing, and now you've got
this. We can get this up, on the chart. Go on, sorry.
And now you've got more of a kind of physical and derivatives making up most of the open interest, that they are that kind of more mature, measured player rather than funds who are just we need to make money on gasoline here, let's just go balls to the wall long, regardless of any kind of fundamentals or anything.
But look at that rise up. What is that from mid-April, early April to the early May? It's such an orderly rally, and then a nice orderly profit take. It's
about a nicer chart you can get for
I mean, the market, maybe we should have put that as, it's been and gone, but that's for sure a gold rush, right? That's probably where the market's made a decent amount of money, not taking the biz, taking it off and cleared the way. This looks like to me these kind of, it's leveled off, but it's not too volatile. I think it's just not really been looked at. The open interest is lower. People don't really have risk on. They've moved their risk to, say, short NAPFA or whatever it is. But it looks like that just seems to me like that's been dragged around by the other product cracks as a function of the refinery margin. I think that maintains that. And on the basis of that, you would say it's kind of should trend a bit lower. But actually, I think now that we are starting to see gasol weaken quite considerably and naphtha, and I think fuel will go with it, something also will hold up. And I think it makes sense that gasoline kind of holds here. So I would be not really bullish, but if I had to say up or down, I would say up.
Especially after some profit taking.
Exactly.
You say, I feel like it's
reversion to the mean again.
Reversion to the mean, and if the crude bearishness and everything materializes, then I feel like gasoline could hold.
I'm bullish, not because of technicals, just because of fundamentals, I think. Stocks are fairly low in the US, about level with last year, which is definitely in the lower part of the 2020s, 24 range. And the physical differential, the physical barges pricing for Europe has kind of recovered. It dropped a bit last week, but Memorial Day on Monday in the States, time to drive.
Yeah, and the market isn't seeming to price in huge demand increases, but we might get one. And, I think we all agree there.
Yeah.
All right, that's great, guys. Thanks very much. And that's where we'll wrap it up. So thanks, listeners out there. And please make sure to like, feedback, comment. We've had a few nice comments, people commenting on people's haircuts, people saying that they're finding it very useful, which is always really, really nice to hear. And I guess the most common thing we've heard is you're liking the explanations that we're putting in the bottom. So we'll keep that going as much as we can. Remember, on flux.live, there's loads of free information there if you play around there. There's glossaries, there's explainers. onyxmarkets.co.uk is our retail trader. You can trade yourself, but you can also go and get a bunch of videos there and explainers. There's a whole section of we've written together on, you know, how to look at the market, how to speculate, how to hedge. Go to onyxmarkets.co.uk and go to the world of oil derivatives section. Plenty there. Again, hope you keep listening, and the next video will be an extension of this when we talk about more of the trade ideas, how they've gone, and new trade ideas. So make sure to check that out and all the rest of the videos too. Thanks guys, and see you again soon.